Welcome to Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. Forget the Fed. It all seems to be about fiscal policy these days. But it's not just about spending more money. We're hearing much more about potential tax increases. So this week, we had US strategist John Tierney give his take on the latest Biden proposals for a capital gains tax increase and its implication for equity markets. To balance matters, we had another piece on the Macrohive site on Fiscal, this time looking at the global picture. Dominique Dworfraco writes on how Europe might surprise all of us with a much more stimulative outlook. And we can't have a week without discussing inflation, so we featured an excellent analysis by star economist Phil Suttle on the upside risks to inflation. You can become a member at Macrohive at macrohive.com to get access to all of these pieces, as well as our member Slack room, which contains a healthy, non-toxic discussion on markets, quite different from what you see on Twitter. Your first month is free, and then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call Macrohive the hidden gem for investors. So once again, just sign up at macrohive.com. We're also proud to have Masterworks.io as a sponsor of this episode. There was a recent Bloomberg article showing average prices for NFTs, non-fungible tokens, having tumbled almost 70% from their peak in February. If you're anything like me, putting your money in real, tangible art by established blue-chip artists makes a lot more sense. That's where Masterworks.io comes in. Masterworks.io lets you invest in physical blue-chip art by top artists like Monet, Basquiat, and Picasso via SEC-qualified Reg A offerings. From 1995 to 2020, contemporary art prices rose 13.6%, had a lower loss rate than gold, and a 0.01% correlation factor to equities, the lowest among the 10 major asset classes. That's the reason why 84% of the ultra-wealthy collect art. It's been a great way to diversify your alternatives portfolio while hedging against inflation. So head to masterworks.io to learn more. Macrohive listeners can skip the 10,000 person waitlist. See important information at masterworks.io/disclaimer. Now, on to this episode's guest. We have Jeff Snider. He's the head of global investment research for Alhambra Investment Partners. He started his career in portfolio management and equity research before focusing on broader investment research since the 2000s. He's a true alternative out-of-the-box thinker, so I'm sure you will enjoy the conversation I had with him. So on to our conversation. So welcome, Jeff. It's great to have you on this podcast. And I must say, I feel as though I know you because I've been listening to your weekly podcasts for the past few months or so. You might not know me, but I know you, it seems.
Well, thank you for that. And thank you for having me on. It's always great to have an opportunity to talk with intelligent people who are deeply interested in the minutia and the details of the daily world, and not willing to just sit back and accept the shorthand and the mainstream explanation for everything. People who want to talk about these things and really get into them in a serious fashion. Always happy to do that.
That's great. No, appreciate that, Jeff. And before we get into sort of the meat of our conversation, I always like to ask our guests something about their background, their origin story, so to speak. So it'd be good to learn about what you studied at university or college, as you guys call it. And then was it inevitable you were going to enter finance? And how did you end up where you are today?
I have a very, very boring background. Very undistinct and I went to a small college in Buffalo, New York called Canisius College. I had a bachelor's degree in finance, and I had intended to do like most people did in the early to middle 1990s to enter the finance industry, to be a portfolio manager, to manage stocks. .coms were on fire. Everybody wanted to be in equities. That was the place to be. And so that's what I started out doing at a small registered investment advisor in Buffalo, New York. And in order to be what I thought was a good portfolio manager, I had to get involved into equity research. In doing some equity research, I started to look at, of course, the banking system, the financial system, and taking it from an equity perspective. You start taking apart balance sheets. You're looking at what banks are actually doing. And what I started noticing was that what banks were doing and what they were reporting, and even if we get into the footnotes, it wasn't like what they taught you in school. It was like, wait a minute here. There's lots of other stuff going on that I have heard nothing. I mean, what the hell is a Eurodollar? What is repo? What is a repurchase agreement? What are these things? It's not like these are, trivialities, some small things here or there. There was all sorts of weird stuff going on. Derivatives. What are these things for? Why are there tens of billions and now hundreds of trillions? I mean, all the stuff that's happening that they didn't really teach about in college, and started to ask around and other people in the industry, and they didn't have any answers either. And, to be frank, a lot of their answers were, why are you asking? Why do you care? And I'm like, wait a minute. I'm trying to make a career out of a portfolio manager. And what I'm hearing is more questions, more knowledge is a bad thing. Whoa, okay. So that had set in motion sort of my transition later in life after being a portfolio manager for a number of years to do more research-oriented stuff, more writing, more deep investigations and things like that. So over the last 25 years, I, intended to be a conventional portfolio manager and have become something completely different, which is basically all research, all writing, all, doing podcast appearances and things like that to tell people what I've been doing for the last 20 years, which isn't really conventional portfolio management.
Okay, yeah, understood. Okay, that sounds good. A nice journey there. I guess maybe we can start with the global financial crisis because, that's really where we saw widespread use of, say, quantitative easing. And, the narrative around then, and we're hearing similar things today, is that central banks have kind of crossed the Rubicon. They're doing something they've never done before. They're printing huge amounts of money. This is going to lead to rampant inflation. And that was kind of the narrative. Now, obviously, central bankers themselves didn't articulate it in quite such an aggressive fashion, but there was this expectation that...
Well, they couldn't. I think that's an important point. I don't think most people are aware of. Quantitative easing has turned 20. It started in 2001 in Japan. And even before the financial crisis, central bankers knew quantitative easing didn't work. Let me say that again. Before the financial crisis, central bankers knew that quantitative easing didn't work. They had any number of discussions about it. There was any number of studies produced in and out of Japan that said, this stuff isn't working. June 2003 is a time period that comes up for a lot of reasons in the United States. The Federal Open Market Committee in June of 2003, because they were debating lowering the federal funds rate to 1% for the first time in American history, they started to have a whole bunch of staff's discussions and presentations prepared to talk about, okay, if we're at 1%, we're in range of Japan, zero interest rates and maybe quantitative easing. So in June of 2003, their regular policy meeting was all about, or much of it was about, Japan's experience with quantitative easing. And you got to read what they were saying. They knew it didn't work in June of 2003. Now, what they came up with, what they decided had happened was, QE as a theory is good. The way the Japanese carried it out must have been wrong. And it's not the stuff that you think about. If you go back to the first Bank of Japan discussions about quantitative easing, all the way back in March of 2001, they knew that this is not money printing. We're raising the level of bank reserves, but that's not the same thing. In fact, Aiko Shinotsuka, who was the one dissenting member of March 2001 vote for QE, she said, why are we doing quantitative stuff here? We don't do quantitative stuff here. And the reason we don't do quantitative stuff here is because we can't define money. We don't know what money is. The modern banking system has created all sorts of different forms of money. And so if we're going to claim to do quantitative monetary theory here or quantitative monetary practice, we don't know what we're doing. And remember, the original thesis was Bank of Japan in March of 2001 was going to target a trillion yen increase in bank reserves. It's supposed to go from 4 trillion or so to about 5 trillion, which at the time everybody was like, whoa, a trillion yen. Oh my God, this is huge. And then the Japanese discussion was, we don't really know if we have to do something. We don't know interest rates, we've dropped them to zero and we can't go any lower than zero. So we got to do something. So they kind of just threw quantitative easing at the wall to hope and see if it stuck. So by June of 2003, when the Federal Reserve was evaluating their performance, they're like, it was only supposed to be 1 trillion in yen. And yet bank reserves in Japan went from 4 trillion to 20 some trillion. And it still didn't have much of an effect. And it wasn't just the Fed. It wasn't just the Fed staff. The Bank of Japan produced any number of studies in that middle 2000s period, or the decade of the middle 2000s, that said, we think in theory, quantitative easing is supposed to work through 3 different channels. And those 3 different channels are, you have the portfolio effect channel, which is, I'm going to buy bonds from the market, which means I remove those bonds from the market. Typically, they're the safe government bonds. And that's going to force the banking system to go and do some risky stuff. I take the Japanese government bond from you, you have to lend into the real economy. Right. And it sounds perfectly reasonable. And that's a reasonable expectation. The second channel is interest rates, right? If I'm a central bank and I'm buying a bond, it's a non-economic reason to buy a bond that should increase the price of that bond, therefore lower the yields, lower interest rates. So it sounds pretty intuitive, makes perfect sense. And the third channel is sort of their bread and butter channel, which is nothing more than signaling, which is I'm a regular Joe on the street. I'm a consumer. I'm a worker. Maybe I'm an employer too. And the central bank is doing something, and it's doing something big. I don't know what it is. I don't really care to know what it is. All I know is that these guys, they know what they're doing. They're the ideal monetary technocrats. And so we assume they know what they're doing. And if they're doing something big, that's going to be positive and good. So I'm going to spend more money. I'm going to be, I'm not going to be as risk averse. I'm going to hire more people because I'm going to become optimistic. And so that's the signal channel. The central bank is doing something. It's doing something big. I don't need to know what it is, because I trust these people. They say they know what they're doing. The media tells me they know what they're doing. So I don't need to know what they're doing. They're doing something. So through all of those three channels, by 2004, 2005, the study said, we don't see any effect in any of them. The most that they could say about portfolio effects was nothing. Didn't happen at all. The banks ended up selling their bonds to the Bank of Japan under quantitative easing and then buying other bonds back. They just traded one safety instrument for another. There's no portfolio rebalancing whatsoever. Second channel, interest rates. Studies have shown conclusively time and time again, not just in Japan and not just in the early part of the QE period, but for the entire 20 years in every place QE has been tried, it doesn't lower interest rates. The market does. And that was true in Japan right from the very beginning, which was investors, the banking system were buying safe and liquid assets long before quantitative easing happened. So by the time QE comes along, interest rates have already been lowered, and it's the market that lowers interest rates even when QE is in place or whether it's not. So the effects of QE on interest rates are negligible. So that channel didn't really work either. And then that just leaves the pop psychology signaling stuff, right? I'm making people optimistic for reasons they don't even understand. That's really what it comes down to. And that's supposed to raise inflation expectations and all sorts of, econometric types of processes. But what we find again is that doesn't happen either. So all these three channels where QE is supposed to work, even before we get to the global financial crisis in 2008, there was all sorts of evidence from the Japanese experience anyway that says, this stuff doesn't work.
Yeah, I kind of wonder, listening to it kind of makes me think, this is always a treacherous waters to go into when you say, let's look at the counterfactual, but, surely them doing whatever they did must have had some kind of expansionary effect.
Yeah, you get into jobs saved, right? Well, we didn't create any job, but it would have been worse if we hadn't done that. And it's impossible to say, I don't believe it, but if you want to believe it, I have no way of arguing against it, right? I can't say that, well, if they had done nothing, it might have gotten worse. When you look at the QE experience, and of course, obviously in 2008 and 2009, it's hard to argue that it had much of a positive impact in that way because it already got worse. It already got really bad. And it already got really bad, despite the fact that though the Fed didn't call it quantitative easing in the fall of 2008, it undertook much of the same stuff anyway. It expanded its balance sheet. Bank reserves increased by a tremendous amount. It was 700 billion at one point, which back then was an enormously different change. So it wasn't quantitative easing, but it was the same sort of principles, especially through the three major channels that economists and central bankers think they work through. And yet from October 2008 until March of 2009, which is a half-year period, the crisis continued anyway. So I have a hard time thinking that, the Fed kept it from being worse because it got worse despite the Fed's best efforts anyway.
Yeah, no, I hear you. And you mentioned that when the Fed looked at the Japan experience in those papers you mentioned in 2003, they said in theory it could work, but in practice, the way the Japanese had done it wasn't the right way or something. Did that mean that they had learned something about how to implement it, and that's what they did in 2009 onwards?
No, you would think they would say that, okay, they did the wrong money or they did the wrong type or the wrong. No, that's not what they focused on. They focused on exclusively on the signaling channel. In other words, they've criticized the Bank of Japan because they'd say, well, they were being too realistic about it. They would up the QE quotient. They would raise the level of bank reserves targeted, but then tell the public that they were doing so because of bad reasons. You can't do that. You got to be happy all the time. And so what they were saying is that the Bank of Japan was undermining its own psychology by being realistic about why they were doing these things. They kept saying things aren't improving, so we got to do more QE. In the Fed's viewpoint, in a psychological expectations manipulation regime, you don't do that. You can't do that. You have to say this stuff is powerful. It works. Just go with it. Don't question it, just go with it. And so their answer to why QE didn't work in Japan was that the Bank of Japan didn't project sufficient amounts of confidence. It didn't come across to the public as saying, this crap, you won't even question it. It's awesome. You will never have a doubt. You'll never need to doubt what we're doing. And so that was sort of the idea that QE could work elsewhere, is if you always say it always worked. And so that's kind of what you saw, especially in 2009 and really in 2010, because remember, as early as 2010, here's Ben Bernanke having to do a second round of QE. And why didn't people stop and say, well, wait a minute, we got all this experience in Japan. Now you're telling me this stuff will always work. That's what you said in 2009, that it saved a bunch of jobs and it saved the system from being, Great Depression Part 2. But here we are in 2010, and you're telling me you got to do more? We're already starting to see the similarities with Japan, because they focused on the psychological aspects of what they think is the most powerful aspect of QE. And it all goes back to what Aiko Shunitsuka said in 2001, which is, we can't define money. We don't do quantity money because we can't. We have no idea what the money is in the monetary system. So we're sort of pretending, and we're hoping that pretending and people not asking questions will be enough of a psychological boost to have an impact in the same way that lowering the federal funds rate had. And it's just, when you think about it that way, it really makes sense why it didn't work.
Yeah. And I guess, targeting money supply sort of fell out of favor like decades ago, yet we've kind of resurrected it in some form or another. But let's kind of go to that question of what is money then? So I know you've written a lot about the Eurodollar system. And so maybe you could kind of talk about the types of money that are there and types of money that you think a central bank can control and the types of money they can't control.
Well, yeah, I think we need to look, their predicament in the 2000s and really before that is understandable. If we don't have to be sympathetic to their position, but we understand why she was saying you can't do quantity money. Go back decades before that, into the 1950s and the 1960s. We had a massive monetary and banking evolution, a revolution in the way things were done. Not just the Eurodollar, but different ways banks traded liabilities back and forth that created this monetary system unrecognizable to most of these traditional formats, to what's printed in the textbook. Again, getting back to what I said at the outset of my own journey of discovery, was I found these monetary evolutions in the 90s and was like, what the hell's going on here? Realizing that this had been going on for decades before that. And if you listen to people like Alan Greenspan in the 90s, he was telling you this. His irrational exuberance speech, his famous speech in 1996, what he was saying was, if you really heard him, that they had no idea what money was because they couldn't define money. He said money supply trends had veered off past several years ago. Well, that's what he really meant. Because we couldn't define money in the modern system, how would we know if the stock market's behaving rationally or not? That's what the rational exuberance he was talking about is, we don't know. We can't look at the monetary system and say it's doing this because we don't know how to define it. So you have this massive evolution in money. And what central banks decided to do, again, getting back to Aiko Shunitsuka, was we'll manage people's expectations. In other words, we'll signal to people that we're doing this or that, and we'll give off the impression that, we're in charge here. And in one sense, we're going to let the banking system take care of the details of money. We don't know how to define it, but they must because they're trading it. The banking system, global banking system, is trading stuff back and forth all over the place. We can't keep up with it. But if we sort of influence bank behavior, that will allow us to influence the money system without having to actually understand how it actually works. So that was the policy that Shunitsuka was talking about, sort of the expectations, interest rate targeting sort of policy that's more about behavior than actual money. Except when you encounter the zero lower bound and you can no longer influence behavior by raising or lower interest rates, what do? That's where we get into the point, what does the central bank actually do in its day-to-day operation? And it's really just bank reserves. And bank reserves are nothing more than an accounting remainder after they undertake this quantitative easing asset swap. And it sounds like it should be money. It's a bank reserve to begin with. It's something the central bank comes up with in its accounting. It's a deposit balance that a bank holds at the central bank. So how can that not be money? And the answer is, when you look at the evolution of banking throughout the 50s and 60s on into the 70s, 80s, and 90s, it's really whatever banks decided money was that became money. And if there's no real purpose or no real reason for bank reserves in this other system, then the central bank increasing the level of what are largely outside of the monetary system, increasing the level of the balance of bank reserves systemically, they don't necessarily have use in the actual effective monetary system. So the central bank creates bank reserves specifically that don't necessarily have an easy, direct way to be used monetarily in the actual monetary system that the banking system actually takes care of. So if you have a banking problem, that means you also have an effective money problem. And the modern central bank doesn't do with modern money. So all it does is bank reserves. So again, we come back to why did quantitative easing not work in Japan? And then, of course, everywhere else it was adopted is because it isn't actually money printing. It's just the creation of bank reserves through this asset swap that doesn't work through the other two channels either.
Well, I guess this also goes then to the point of perhaps why QE didn't work after the global financial crisis, which was that banks were in bad shape. What one is they were in bad shape, they became risk averse, and then the regulation changed as well, which constrained their balance sheet. Now, do you think that was a factor of why, modern money, so to speak, didn't expand?
You mean talking about regulations?
Regulations, yeah.
No, I think regulations did play a part, but what you just said before that is the bigger part, which banks became risk averse. They became aware because for several decades, it had been from the 60s, 70s, 80s, 90s, and middle 2000s. Before August of 2007, it had been believed by the banking system that there were very little risk because his history said, look, there doesn't seem to be a downside here. Everything works no matter what we do. Bigger is always better. More, no matter how ridiculous and insane. And part of that was, this lore and this legend of Alan Greenspan and the Greenspan put that, if push comes to shove, the Fed will come in and bail us out. Realizing the fact that the Fed has no way to actually do that, it was one of those shorthand myths that got perpetuated for a long time because it was never tested. And so you have recency bias and confirmation bias, all of these things working before 2007. And then when things started to go wrong, it became, oh, wait a minute, all that stuff that we thought for decades, it's all falling apart really fast. And oh, by the way, I'm on the hook here. The Fed looks at Bear Stearns as a success when the rest of the banking system look at Bear Stearns like, oh my God, I don't want to be the next Bear. My equity's wiped out. I'm no longer a manager of a bank. My cushy job where I get paid millions of dollars just disappeared. I don't want to be Bear Stearns. So the banking system looked at the early crisis period and said the risks that we thought didn't exist were actually there. And worse than that, some of the things that we thought were redundant structural reinforcements actually turned out to be bottlenecks. They made it worse. So we have this asymmetry that we didn't appreciate suddenly creates the potential for the worst of the worst case, which is a failure, which is I'm out of business. And that's a stark change in behavior. So long before we got to Dodd-Frank and Basel III and all those other stuff, the banks had already constrained their own balance sheet. And you can talk to any number of bankers in the industry and they'll tell you the way things operated before 2008 was completely different. If you wanted to do some cowboy stuff, all you had to do is call up your boss and say, I'm going to make you money. And they would go, yeah, whatever you want to do, you go ahead. Bigger's better. There's no risk. Nowadays, you want to do cowboy stuff. You've got 8 different committees. You've got lawyers. You've got management. Banks operate completely differently. And Dodd-Frank and Basel III only made it worse. They only hardened those tendencies to say, you need to be risk averse because if you're not risk averse, we're going to see it in your numbers and then we're going to tell everybody about it. So it reinforced some of the worst kinds of behavior. And I say worst kinds of behavior, not in the respect that we want the banking system to operate like it did before the crisis, but monetarily speaking, we need risk-taking banks. Otherwise, we don't have monetary growth. That's where the money growth came from. Not from central bank policy, but from bank policy saying we're going to take on risks, often in really ridiculous ways. And that's how we'll perpetuate this monetary system, which creates the necessary monetary and financial credit resources for an expanding global economy.
Yeah. And there's a couple of follow-up questions here. Like one is, what happened then in the 1970s? We had rampant inflation, in the 70s. What's your take on that, in the context of what we're talking about here of money and so on?
I used the term that economist Paul Samuelson came up, I think it was in 1971. He said it was benign neglect. And what benign neglect actually referred to was Triffin's paradox. Now, Robert Triffin's paradox described the situation after Bretton Woods in 1944, where the US dollar and the British pound were linked to the respective domestic reserves of gold. What Robert Triffin observed by the late 1950s, as this monetary evolution was starting to really take hold, Triffin said, look, you can't have a national currency be an international reserve currency where it's tied to a national store of reserves because you need more currency throughout the rest of the world to perform the roles of a global reserve currency than are available to be redeemed in the national currency's reserves, which simply meant You have to have more dollars outside the United States, and the risk under the Bretton Woods system is that those dollars are going to be converted into American gold, which is exactly what happened in the late 1950s. And so as this monetary evolution was taking place, this Eurodollar system started to develop. What happened was it began to solve Triffin's paradox in an ad hoc way, an organic way, where the banking system started to maintain the functions of the global reserve currency without any administration, regulation, or intervention of authorities.
And just for clarity, just in case listeners get confused, Eurodollar, we mean here offshore dollars traded outside of the US system.
Right. It has nothing to do with the euro. It's not the European common currency. It's in the term Eurodollar was coined in 1960, but I forget the guy's name from the Financial Times, because he stumbled across it by accident. And what he realized that there was all of these dollars being traded outside the US, primarily in London, but throughout mostly Europe, but not just Europe. And so that was the shorthand. It became the Eurodollar because it was a European or continental dollar. There was robust Eurodollar market in Japan too, as well as Canada, in Montreal, really all over the world. But yes, Eurodollar, when you hear the term euro or anything following it, it just means offshore. So there's actually a euro, there's a euro yen. It just means offshore yen or offshore dollar. But this monetary system is primarily US dollar denominated, that it takes place offshore. Because it takes place offshore outside the US jurisdiction, it's outside of the control of the Federal Reserve. And getting back to what we're talking about with Triffin's paradox, you now have a US dollar technically, but it's delinked from these stores of US reserves. And effectively in the 1960s, we had the Eurodollar take over the role of global reserve currency, while authorities became increasingly aware that was taking place and loved the fact that it was happening because it took a huge problem off their hands. So by the time in August 1971, when President Nixon closed the gold window, the Eurodollar system had already taken over the functions of global reserve currencies in the sort of post-Bretton Woods era, which began much, much earlier than 1971. Now, what happened was that simply got out of control, right? You have monetary evolution throughout, these dollars flowing throughout the entire world, not just dollars, but all sorts of currencies. This offshore monetary system going absolutely crazy because, nobody had any idea what was really going on there. And that's what led to and what created a good chunk or a good piece of what became known as the Great Inflation.
Yeah. And if we kind of fast forward now to today, we're jumping around lots of different time horizons. There is a viewpoint today that, look, banks are in a healthier position today than they were in 2009. So they should be less risk averse than before. Plus, on top of that, you have the fiscal side. The government has sort of stepped up its balance sheet and it's spending lots of money and giving people checks and so on. And in some ways, you've ended up in a kind of a quasi MMT situation where the central bank prints. In the past, that didn't enter the real economy, but now they're printing, the government is taking that printed money and now giving it to people. And as a result, this time is different and this time it will work.
Well, let me take the first part of that first, which is that banks, yes, it is true that the big banks around the world, they're in no danger whatsoever. Their balance sheets have been reinforced. But I would argue, I think that their data, even just look at their balance sheets themselves, that they have become so because they are risk averse. Yes, they're healthy. They're not in any danger of failing, but they would say, it's because we don't take risk. We do the opposite. Look at what most bank assets are comprised of nowadays. Bank reserves and government bonds. There's no lending, practically no lending. There's no lending growth, I should say. Lending growth has been practically zero. Even the last year or so, despite the Fed's best efforts, banks are not lending. They are not lending. So I would say that no, the banking problem remains, which is balance sheet constraints for the reasons we discussed before. So they are risk averse, even though they are very well fortified. You're not going to see another Lehman Brothers. That's just not going to happen.
Again, that's a fair point. They're safe because they're risk averse, and so they're going to remain safe by remaining risk averse in essence.
And it sounds ridiculous, but in the context of the banking system, the world that we live in, it makes perfect sense. So because we don't want to be that Bear Stearns, we don't want to be Lehman Brothers, we are not going to take that much in risk because we appreciate the fact that the Fed doesn't do money, the monetary system's broken, and if something does go really wrong, we could find ourselves in a lot of trouble. There is still that belief out there, and I think it's only been hardened by practical experience over the last 15 years, which says you can't depend on the Fed, you can't depend on the system. It's still kind of breaking down every once in a while, And so the risks are continually large. Even if the rest of the public doesn't see it on our balance sheet, we appreciate it in the way that we actually construct it, which is safe, risk-averse, liquid assets. Those are always preferred. It's always about, do I survive tomorrow if something goes wrong? And so the other side of that is, quite naturally, if you're a policymaker, knowing the Japan experience, knowing the American experience in the immediate aftermath of the European experience as well, where the banking system becomes this huge block. They call it the clogged transmission mechanism, right? Which is, gives themselves a little bit too much credit, but that's what they call it, which is essentially that we try to do monetary policy, and it's like banging our heads against the wall because the banks keep saying no. No matter what you do, ECB, negative, you can punish us with negative rates. We're not going to lend. We're not going to do risky behavior. And so it makes sense. If the banking system is your problem, I'll go around it. So instead of trying to influence bank behavior or even give them bank reserves they don't need, I'll just give cash to the public. I'll give cash to businesses. I'll go right out. The government can borrow all the bonds it wants. It doesn't matter about QE. Because banks are risk averse, they'll buy safe liquid instruments, which is what governments offer. You don't even need the central bank to finance the debt. The banking system will quite naturally do it for it. And so we'll funnel all of this borrowed debt from banks who want to hold safe paper, and then the government will redistribute into the real economy instead of going through the banking system. And it sounds like, well, there's your answer. That's the magic right there. Except the Japanese thought the same thing in the 1990s. And they did all the same stuff. And guess what? No inflation, no growth. And the reason is the government redistributing money into the real economy is not the same thing as the banking system intermediating real economic processes that create sustainable wealth. The government creates lumps in the economy. It creates artificial intrusions that are often wasteful and harmful in the long run. It's inefficient and ineffective. Yes, the Keynesians would argue that you're raising aggregate demand, and that's true in the short run. But as we've seen from Japanese experience, as well as a lot of historical experience elsewhere, government interventions in this fashion, even if they're directly giving grants into the direct economy from monetary sources, it tends to have a intermediate and longer term deflationary impact because it's wasteful and inefficient. Think about UBI in this context, for example. What is UBI? It's paying people not to work. So what is more harmful to an economy? Locking up a significant amount of the labor pool and saying we're not going to use it. An economy depends upon efficient use of resources. And if the government comes along and says, for non-economic political reasons, we're going to take a chunk out of the labor pool so that you can't use it or they don't want to work at the rates that you want to pay that are profitable for you to pay, it becomes a deflationary imposition. So there's any number of reasons like that. And again, we see this in Japan in the 90s and 2000s, where they tried to get around the banking system, realizing that was their primary monetary impediment. And it didn't create inflation. It didn't create economic growth. In fact, you could argue, and this is a debatable point, but you could make the case that increased government intervention actually made it worse, made the lack of growth, lack of everything.
And I guess when we talk about risk, one thing that has been very evident in recent years has been all the odd kind of flash crash type dynamics we've been seeing in markets, whether that's flash crashes in equity markets or whether it's repo blowouts and so on. We've seen some this year as well. We obviously saw some in March last year. We saw the repo blow up a couple of years before. I mean, what are your thoughts on those sorts of things that are coming up?
It's a symptom of the big problem, the major problem, which is the dealer net. The banks that we're talking about, they're dealers. They also have money dealing activities embedded within them. And for some of them, that's their core business. Especially some of the bigger business. And what we're really talking about when we see these types of market breaks or liquidities or illiquidity events, September 2019 is a perfect example in repo, where what we saw was as things started to happen for various reasons, it really was a small technical thing. It wasn't a big deal, but it became a big deal because the dealers stepped out. They said, you know what, we're risk averse, or we're balance sheet constrained, whatever the reason is. As things started to show up, as this illiquidity started to build in the repo market, which is where you would expect dealers to step in, because as the repo rate, for example, in September 2019 went up and up and up, a dealer could have made his entire year on that one day alone. There was so much profit opportunity to step into the repo market. And the opposite happened. The higher the repo rate went, the less dealers were involved in the marketplace because they reviewed that rising repo rate and the illiquidity as a danger. So it's a symptom of the fact that dealers become risk averse at the first sign of something wrong, when the system depends upon dealers becoming risk takers when these things go on. That's what a dealer's supposed to do. And the reasons are, for what we just discussed, balance sheet constraint and everything else that's going on. So that was a very poignant example of these, I don't want to, how you want to, they're not really anomalies because they happen more often than not, right? They happen quite regularly. And time again, we see that the dealers are very shy and very averse, which presents all sorts of systemic implications, including the rest of the system becomes risk averse because it realizes that if something goes wrong, I can't count on the Fed. I can't count on dealers. These markets go illiquid at a moment's notice. I got to be very cautious and careful. It becomes a systemic issue from that point forward, or just reinforced because it's already been the way things are looked at.
That's a good point. Yeah. So actually, it reinforces the bank's risk aversion in general because of these sort of the fragility of the system.
Yeah, and I think it spills out. We focus on the banks a lot, but it's also there's a huge non-bank sector that contributes to this too, and it spills over to them because they don't have any recourse to anything. If a non-bank has, it is overextended, and it depends upon the repo market for its funding or its backstop funding, you're really dependent on dealers to lend you collateral. And so, if you look at dealers becoming risk averse on these types of abnormal events, you have to think, well, geez, my collateral position isn't very good either. And you have to become risk averse for the same reasons. It really becomes a systemic thing. And the only way that the central banks try to circumvent or combat it is through this pop psychology crap where they say, I'm doing a bunch of stuff. I'm creating trillions of bank reserves and everybody's supposed to be happy about it. Well, that's not going to solve the problem. It's not going to help either the banks or the non-banks anyway. So it's not really a clogged transmission channel. It's central banks are not central. That's really the case here.
And what are the market or investment implications of all of this? I mean, from the sounds of things, it seems like we won't really see much, if any, inflation. So that suggests that bond yields, will probably remain on the low side. Does this have any implication for equities, or how does all of this fit into equities? Because obviously equities in general have performed quite well over this period of time. I mean, is that linked somehow to QE and all of these things, or is that just a separate set of behaviors?
We'll take the equity side first. That's really what quantitative easing its primary audience, the psychology I'm talking about, is portfolio managers buying equities. The primary channel for signaling is through the stock market because it's, academically, economists and central bankers believe that consumers and businesses get their information on the economy from the New York Stock Exchange. So if you could influence the price of shares, believing that consumers follow the stock market more than they follow, GDP reports and payrolls and things like that, then you've kind of accomplished your primary task, which is you think higher share prices will allow more risk taking in the real economy, regardless of the banking system. So QE's primary psychological audience is the financial services industry, which is only too happy to buy stocks anyway. And of course, there's also passive invest that you have to take into account. I don't know if you know Mike Green, who's done a lot of work on passive investing. And so the stock market takes these signals from QE and it just reinforces behavior it already takes anyway. So regardless of economic fundamentals, we're not discounting actual economic behavior. We're taking QE signals and saying there's no risk. In history over the last, certainly since go back to 2011, the last time we really had other than last year, had a really big sustained sell-off, it seems to be that there's no risk in stocks. Apart from these periodic liquidations like March of 2020, where the monetary shortage gets so bad that even stocks have to be liquidated. But outside of that, it appears to be that Greenspan's put is alive and well, even though there's no money in it. It's all psychology. So that's the stock part of it. And then you have the bond side of it, which is saying, wait a minute, this is all junk. There's no economic growth. There's only risks. Banks are the ones buying these bonds. The banks and the non-banks in the monetary system alike are the ones that are saying, look, we only want safe liquid instruments because we're concerned about safety and liquidity, which is the opposite interpretation of stocks. And this is, I'd say that I tell people this all the time. This is the interest rate fallacy personified. And the interest rate fallacy is another one of those things that the textbook gets wrong, which is we're conditioned to believe that low interest rates are stimulus. And that makes sense. It seems to make sense, right? I mean, if we have lower interest rates, it's cheaper to borrow. So that should be stimulative. But it's historical, as Milton Friedman said in 1967, no, historical experience runs exactly contrary to that. Low interest rates are a sign of tight money in the real economy. Low interest rates are tight money. Think about the 1930s in the United States, Great Depression. What were interest rates in the 30s? They were low, not high. And so as we're seeing today, the bond market is continuing, even after the sell-off this year, rates are still really low. They're extremely low. And what that says is the market is saying tight money low inflation. And that includes taking into account what Joe Biden's stimulus and infrastructure, everything is going to be, the fiscal end run around the banking system block, all of this stuff. The bond market is saying it does not come out to be inflationary. At least we don't think so right now. It's a really, nothing has changed. Yes, there's lots of big stuff going on in the short run, but the intermediate and longer term picture, it remains the same ugliness, but even a touch uglier.
Okay. And if we kind of step back then, so what do you think could cause inflation? What types of things would you want to see to make you think, hang on, things have changed now, we are going to see inflation?
Well, I think we have to define inflation first, because it means something to different things to different people. And it's really, what are we talking about in the traditional economic context? Inflation is a broad-based and sustained increase in consumer price. So it's not food prices going up, or college going up, or my medical expenses are going, health insurance is going up. It's everything going up. Okay, so it's broad-based increase in consumer prices, and it's not just everything going up this year. It's everything going up this year, next year, the year after, the year after that, year after that. Going back to the 1970s, it wasn't just gasoline prices that got outrageous. It was the price of everything. Everything went up for year after year after year. That's inflation. Now, what central bankers shoot for and what they tell you they're looking for is a very small amount of that. And that's a good thing, because they think it gives them a margin of error between inflation and deflation. So that's why, they have this inflation target of 2%, which is, you would think ideally price stability is zero. And what they argue is that broad-based sustained consumer prices at a low level is what we should target for, because it gives the economy some margin of error from deflation. So when we're talking about inflation, that's what we're really talking about. We're talking about broad-based, sustained, that kind of thing. So yes, we will see spikes in food prices, for example, over the last year. That's obviously been the case, but that doesn't necessarily equate to inflation. And I believe in the monetary explanation, Milton Friedman's explanation, everybody else, Alan Greenspan, anybody else you want to talk about, that inflation is a monetary phenomenon. So if we expect to see monetary, and that's why central banks target it, right? It's a money thing. So if we've been in disinflation because of, again, the interest rate fallacy, the market's telling us money has been tight. And what we just talked about, the Eurodollar system has been broken for 14 years almost. And broken in the sense that it doesn't grow in the way that we need it to. It doesn't offer enough money to the system that needs it to grow. It doesn't mean it's been shrinking and contracting and, it's not 1930 all over again. It just means it's growing at a rate that's insufficient to continue to keep the system operating at its best levels. So what we would expect, if we think that inflation is going to come, the paradigm has shifted out of this disinflationary low growth rut into something better or more consistent. It all comes back to the banking system. It really is that simple, because banks are money. Money is inflation. Without fixing the banking problem, you don't fix the money problem, you can't get the inflation. It's just that it's really that simple. And I think that's what the market is telling you, that despite the trillions in the US, and the trillions of euros in Europe, everything Japan has done, everything China has been done, everything that governments and central banks are doing around the world, we're still not buying it. This is 2021. Interest rates have come back a little bit from their lows last year, but why haven't they come back a lot more? And the answer is because more and more it's becoming, hey, this isn't really different. Governments are doing more, but it's more of the same types of things. It's not fixing the underlying structural issues that have been this way for a very long time.
Okay, no, that's great. No, I think that's a very sort of compelling argument. Listening to you, it does sound like the one area of inflation is probably the size of central bank and fiscal programs themselves. They seem to have gone from hundreds of billions to trillions. So we're definitely seeing inflation there. That's one area we are seeing inflation.
Yeah, and that's the easy thing, right? Because you can see essentially, you can look that up on the Fed's website, and you can see its balance sheet rising. You see the level of bank reserves rising. You're getting checks from the government for, in Europe, I know they do it a little differently, but for people in America are getting checks from the government. They did in 2008, but now they've gotten much bigger and they've become much more, regular. So this is the stuff you see. You see this stuff and you think, well, how can this not be inflationary? But it's the stuff you don't see that actually matters. And that's why I spend most of my time on these bond market signals. And, to be clear, when I say bond market, I don't just mean U.S. Treasuries. There's all sorts of different aspects of the bond market system. There's Eurodollar futures, there's interest rate swaps, there's currency swaps, all sorts of things that go on in these global offshore money shadows that you don't see, that you have to depend upon these market signals to tell you what's going on in them. And it's the stuff you don't see that ends up being most important. think back to our experience in 2009, 2010. We saw the Fed's balance sheet go way up and everybody said, going to kill the dollar. Dollar's going to zero. Inflation's going through the roof. All this money printing. And what happened? The dollar went up and inflation went down. It was the opposite. And the reason was because it's what you didn't see in the shadows that forced Ben Bernanke to do a second quantitative, and then a third, and then a fourth. It's the same exact experience as Japan because banks do money, not central bank. And this offshore bank-centered shadow Eurodollar system said, no, we're not. There's no money. There's no growth. There's no inflation here. There's only risk. We're only risk averse. So no matter what you see happen and it includes M2, for example, M2 has gone crazy in the last year, yet there's still low inflation, yet interest rates are still low. It's because it's the stuff you don't see that's what really matters.
Yeah. No, that's kind of an apt way to end our sort of discussion on the macro side of things. I want to change tack now and just get more personal. And I can tell you consume a lot of content and analysis and so on. I mean, what's your tactics and how do you manage your information and research flow? It's quite easy to get overwhelmed.
Over my desk, I've got papers everywhere. They're just notes and things. But I manage my own information flow because a lot of it's just regular. It's habitual. I need to check this. I need to check that. I need to see this. I need to see that. And when I have spare time, I'll do a lot of primary source research. I'm sort of well known for being the most boring human on earth. In my spare time, I read transcripts of central bank discussions from the 1950s and things like that. And it's good because using primary source material, you can fit that what people were saying back then into this, worldview that I've developed, this Eurodollar system, this modern monetary shadow money system, and see how it got to be that way. And that helps you appreciate what's going on right now. Again, why do we need to pay attention to the shadows? Well, there's all sorts of answers to that from the 60s and 70s and things like that. So it's really about matching, the scholarship you do and the work that you do about past history and understanding the way things work with how things are developing in the real world in real time. And it's a bit of a chore, but it's once you get into that world and understand things in reasonably, sort of like they become second nature. It's not so difficult.
And, you mentioned reading, of course. And so are there any books that have influenced you over your career?
The book that I use the most actually is A Monetary History, which is Milton Friedman and Anna Schwartz' seminal work from 1963. And if you can see my copy of it, it's completely torn apart. And the reason is because there's a lot to like about what they talked about. And really, the book is about monetary evolution, except from an age before the Eurodollar system. What they were talking about is depository bank evolution. And so when I first read it a long time ago, I thought, wow, this is really good because it's out of the box. It's certainly original thinking. It's a different way of looking at things. And I think a lot of it stands the test of time. And in addition to that, if you want to know what a central banker is thinking, all you got to do is read that book. I mean, quantitative easing is in there, zero interest rate, all that stuff is in the book. So it tells you a lot about how things are today. And to me, it sort of represents sort of an endpoint where monetary scholarship had developed in the post-Great Depression era only up until the 1960s. And then they said, oh, Milton Friedman wrote this book. We don't have to study money anymore. It's sort of like, okay, we've left off here. And now we need to fill in all the rest of the blanks over the last 50 years.
Yeah, that makes sense. Okay, no, that's all great. And if people wanted to follow your work or your thoughts, what's the best way for them to do that?
I post regularly at my company's blog, which is alhambrapartners.com. We also do a podcast, as you referenced, with my co-host, Emil Kalinowski, who's offshore in the Cayman Islands, which makes it very appropriate. We talk about Eurodollars and shadow money. That's called Eurodollar University's Making Sense, and we do that regularly every week. Usually we're talking about what's going on in the world, as well as we always try to take some of these more intricate and complex topics apart and sort of what we hope is a way that even a novice audience would understand. Like, for example, a couple of weeks ago, we looked at how collateral works in the offshore framework, where it comes from, how it goes around, and why banks do some of these interbank stuff that they do in the repo market.
Yeah, that's great. And I'll include links in the show notes. So with that, I'd just like to thank you. You've been an excellent guest. I've learned a lot in our conversation, and yeah, it was excellent.
Thank you very much for having me. Like I said, I've always loved having these conversations with people who are interested in a different perspective for sure. What I hope is a compelling perspective, at least one that makes some kind of sense.
Great. Thank you very much. Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a nice comment, and let other people know about the show. We'd really be grateful. Also, sign up to become a member at MacroHive at macrohive.com. We'll be back soon, so tune in then.